Talk more about the broader markets in the week we've had so far with Liz Young, head of investment strategy at SoFi. Is the S&P going to get into an actual correction? Do you expect that? It's down about 9.6% from the highs now, Liz.
Well, I think there's been a decided tone shift in markets where you've got more investors looking for reasons to sell than reasons to buy. And anytime you even look at what happened this morning in the pre-market, enthusiasm for buying, it sort of wanes either throughout the intraday session or even in the pre-market before we open. So I do think we probably get to correction territory. We are not far from it right now. It may not happen today, but I don't think we're far away. And because we've blown through some of the levels of support that people were looking for a bounce at, I do think that it probably goes lower.
And given the 4.9% hot GDP number and the geopolitical backdrop, Liz, maybe we should be surprised that things haven't been, that it hasn't been even weaker. What's the next positive data point that could turn things around, or is it going to be more of sort of this, drip, drip, drip of negative news?
I think a lot of people are surprised that it hasn't been weaker. And one of the interesting things that investors should watch today, we're going to get the PCE data. If you look at just the expectations for core PCE today, which, as we know, is the measure that the Fed watches most closely, expected to come in at 3.7%. The projections that the Fed has for the end of this year are 3.7%. So even they don't expect it to come down much further from here. So I do think many investors and economists and strategists have been surprised that things haven't been weaker already, but I do think we're seeing cracks. And to answer your question about what's the data point that would change it and turn things around, I think we'd have to see that the consumer did stay strong. So far, that has happened, but we're seeing some weakness, and you're seeing things like auto loan delinquencies rise, credit card delinquencies rise. So there is concern out there that the consumer is starting to pull back, not to mention that the market has sniffed it out to some degree, where you've got cyclical stocks down, retail stocks not trading well, bank stocks, particularly ones that are exposed to consumer lending, not trading particularly well. So I don't think anybody is entirely confident that we're not going to hit a period of contraction, at least in consumption.
Just listening to you, I just have a feeling when we see consumer data that there are some people that wish it wasn't as strong for the market. Some people that want to be long, that think the strength of the consumer is actually one of the things causing the Fed to say higher for longer, and maybe it influences long rates. And it would almost be a relief. We almost look for weakness in the consumer so that we can stop worrying about interest rates going to 5.5% or 6% on the 10-year.
Well, our economy, as we all know, is driven 65 to 70% by consumption. And the Fed has said over and over and over again that they need to see a period of below trend growth in order to really take care of the inflation problem.
That's my point. So what should we hope for then?
Well, in order to see below trend growth, so in order for the Fed to be satisfied with the job that they've done and with where inflation is, we have to get to that below trend growth number. 4.9% GDP growth is far above trend. Their trend estimate is 1.8%. So in order to get to that place, we would need the consumer to cool.
Okay, so when you said the next important data point for what could turn things is the consumer, you mean the consumer slowing? Is that a positive if the consumer is slowing? That's what I'm saying.
In some regards, it would be a positive, just in the sense of bringing some of that consumption down to a more manageable level so we get supply and demand back in balance. But the trick is, and this is the part that people are worried we can't pull off, is that the consumer doesn't slow too much. The other piece that we haven't talked about is the labor market, and the consumer will keep spending as long as they're employed. If the labor market gets hit, and we're hearing companies talk about cost cutting, if the labor market gets hit, consumption will slow much faster than I think we probably want it to.